picture this scenario, right? It is late 2025. Australian small and medium businesses have just pushed through this um, brutal economic environment.
Oh, absolutely brutal.
Yeah, and they actually managed to see solid sales growth. Like, the revenue was actively coming in the door.
Right, but then the end of your financials are tallied, and an alarming number of these exact same businesses completely miss their profitability targets.
Exactly. They sold more, they worked harder, but they hit an absolute wall on the bottom line. And, the culprit isn't just inflation.
No, I mean, it's a collision of rising material costs, intense labor pressures, and critically inefficient operational systems that are just suffocating scale.
Right. And when you aggregate all of that friction across the country, you end up with a national productivity growth rate that is flatlined at a dismal 0.07% in the market sector.
I mean, a 0.07% growth rate across an entire sector is essentially paralysis. Businesses are just running on treadmills, expending maximum energy just to stay in the exact same place.
And that is exactly what we are dismantling today. So welcome to all the followers of the C9 podcast and business page who are tuning in. If you are an Australian business owner or, a C-level executive, you are definitely in the right place. I'm Lex, and I'll be guiding you through today's deep dive.
And I'm Vera. We have engineered a custom deep dive for you today, really unpacking the transition from off-the-shelf software to tailored business systems.
Yeah, we are going to explore why 2026 is the ultimate tipping point. Like the specific moment where the generic accounting software you've relied on for years stops being a convenient tool.
And actively becomes a major bottleneck for your enterprise growth.
Because the reliance on generic platforms in the Australian market is just staggering. I mean, we are looking at a landscape where Xero holds over 60% of the market share.
Yeah, and MYOB sits at roughly 20 to 25%. And, well, we should acknowledge that when an enterprise is just starting out, these tools handle basic bookkeeping beautifully.
Oh, sure. They are great for the basics. But as operations scale and the complexity increases, these platforms really begin to fracture under the pressure.
They do. And the most immediate breaking point we are seeing right now revolves around single-touch payroll, or STP Phase 2.
Right, because STP Phase 2 is now fully enforced across the board in 2026. And the mechanics of this compliance shift are catching so many finance teams completely off guard.
Exactly. Relying on a generic software vendor's claim that their product is, STP ready is becoming a massive operational trap.
Wait, really? Because I always assumed STP ready just meant the software's internal updates handled the compliance automatically. Like you install the update and the ATO is happy.
Well, that is the marketing promise, sure.
Hmm.
But the mechanical reality of STP Phase 2 demands an incredibly precise mapping of every single pay item to highly specific ATO categories.
Ah, I see. And generic software is fundamentally built to cater to the widest possible audience, right?
Precisely. It cannot automatically adapt to the unique realities of a specialized enterprise. Say your business has a multi-entity structure, or you operate under complex industry-specific awards.
Like where casual employees trigger unique overtime and allowance rules on weekends, that sort of thing.
Yes, exactly that.
Yeah.
A generic platform just lacks the customized logic to interpret that. So it will either guess or it will force the transaction into a default catch-all category.
Oh, wow. And a default category in an environment of strict compliance sounds like a fast track to an audit.
It basically guarantees one. Because incorrect income streams, misapplied tax codes, or, misclassified allowances, they don't just result in an annoying error message anymore.
Right, because the ATO systems are heavily automated now.
They are. Those default guesses trigger immediate automated audit flags and potentially severe financial penalties. The software just doesn't possess the contextual awareness of your specific industry agreements.
Meaning the burden of compliance falls right back onto your human workforce. Finance teams are probably spending days executing grueling manual forensic reviews.
Every single pay cycle. Just to ensure the software hasn't accidentally invited a tax audit?
So they're manually patching holes in a system they are paying a premium to use. And that financial premium is another massive pain point, right?
Oh, absolutely. We are seeing this phenomena of aggressive subscription creep.
Let's contextualize that because it goes way beyond just a standard price hike. It operates much more like a predatory utility model, or, well, it's actually like buying a budget airline ticket.
Oh, I love that analogy.
Yeah, you buy the cheap ticket, but then you find out you have to pay a subscription fee for your seatbelt, your luggage, and your oxygen.
Exactly. A business starts on a generic accounting platform at a reasonable entry-level tier. But as transaction volumes increase, which is the fundamental goal of growing a business, you hit arbitrary data limits.
All right, so to keep the business functioning, you are forced to upgrade to a premium tier. And then you realize the core software still can't handle your specific inventory management.
So you're forced to purchase third-party add-on applications, and by 2026, those third-party apps are instituting 5 to 8% price increases across the board.
The compounding effect on a company's OpEx is just severe. You are bleeding margins on recurring subscription fees that multiply year over year.
All while only receiving surface-level automation in return. You basically end up paying enterprise-level pricing for a fragmented, pieced-together experience.
And, if a business is paying these compounding OpEx prices for an entire ecosystem of software add-ons, the C-suite assumes it should run seamlessly.
Right, but the data reveals these add-ons are actually creating dangerous data silos. They generate the illusion of an end-to-end solution.
How so? Is it because of the way they market their AI features?
Largely, yes. The illusion relies heavily on how these generic platforms market their artificial intelligence. They boast about 95% accuracy in transaction categorization using rule-based AI.
I mean, 95% sounds incredibly efficient on paper.
It does, until you examine how rule-based AI actually functions. It operates by matching simple text patterns, like if an outgoing bank feed line says Telstra, the rule perfectly categorizes it as a telecommunications expense.
Okay, so it handles the simple, recurring administrative tasks flawlessly.
Yes, but when applied to the complex operational reality of an executive managing variable project costs, it hits a brick wall.
Because generic AI cannot cross-reference a specific customized manufacturing invoice with, say, real-time fluctuations in your warehouse inventory.
Exactly. It lacks the contextual awareness to perform anomaly detection across nuanced operational data, and it definitely cannot generate tailored profitability breakdowns by specific projects or departments.
Right, because it is only looking at isolated lines of data, not the interconnected reality of the business. Which brings us to the integrations themselves.
Yeah. Platforms like Xero boast ecosystems with over 1,000 apps, and MYOB has strong local connections. But the reality is much messier.
Because the connections between those core platforms and a business's custom CRM or bespoke operational systems remain incredibly patchy.
And the mechanism causing that friction is the nature of generic APIs. An API is simply the software bridge that allows two platforms to talk to each other and share data.
But the APIs provided by generic accounting platforms are built to be one-size-fits-all, right?
Yes, they're like massive public toll roads. When you attempt to route highly customized data from your proprietary CRM across that generic public road into your accounting software, the translation is incredibly clumsy.
Like data fields don't match up or line items just get dropped entirely.
Exactly. And the immediate downstream effect of that clumsy data translation is manual intervention.
Right. A staff member literally has to step in, export a CSV spreadsheet from the CRM, manually reformat the columns to match the accounting software, and upload it by hand.
Which completely defeats the entire purpose of investing in cloud-based automation in the first place.
The cost of that manual double handling has to be catastrophic for decision-making. By the time a finance team has manually formatted and reconciled all of that, what happens?
The month-end close is delayed by weeks. The income statement the executive team finally receives is severely distorted by time.
And for the business owner or executive listening right now, this is where the operational friction translates into real strategic risk.
Exactly. When your staff is forced to double-handle data, you are actively deprived of a real-time view of your cash flow and specific cost drivers.
You are flying blind. You are making critical resource allocation decisions based on a profit and loss statement that reflects the reality of your business 30 days ago.
You are operating with a rearview mirror exactly when you need pinpoint forward visibility to navigate 2026 growth targets.
Right, because generic software forces your business workflows to bend to the limitations of the tool rather than the tool bending to the needs of the business.
Exactly. So if off-the-shelf software is essentially a force fit that stalls productivity, we really need to look at how tech-savvy competitors are solving this.
Yeah, how are they outmaneuvering this without tearing their entire IT infrastructure down to the studs? Because proposing a total rip and replace of an accounting system sounds like a catastrophic disruption.
Oh, it would be a massive disruption. Fortunately, market analysis, including the CPA Australia 2025 Business Technology Report, indicates a much smarter approach.
Okay, so what are the leading enterprises doing instead?
They are utilizing a layering strategy. Instead of abandoning their core accounting platforms, they achieve massive operational improvements through a shift in software architecture.
I'm struggling to picture this layering concept practically.
Yeah.
If Xero or MYOB is the foundational layer, and it already struggles with complex data, aren't we just building a massive custom house on a cracked foundation?
That is a very common concern, but the architecture functions differently. Think of it less like a house and more like a high-performance vehicle.
Okay, I'm following.
A business retains Xero or MYOB as the standard factory issue chassis, purely because it is street legal, meaning it easily handles the standardized ATO lodgements and baseline compliance.
Ah, got it. So they layer a bespoke software system over the top, essentially dropping a custom-built V8 engine into that chassis.
Precisely. The bespoke layer becomes the operational brain, handling all the heavy lifting and complex logic, while the generic software acts strictly as a compliance terminal.
That makes so much sense. It provides deep bidirectional integration. It pulls raw data from your CRM, specialized inventory systems, and project management tools.
Yes, and it processes all of that information through custom algorithms built explicitly around your unique operational workflows and your exact chart of accounts.
And your specific industry awards too, right? So once the data is processed, sorted, and analyzed, it just syncs a clean, formatted summary down to Xero or MYOB for the final reporting.
Exactly. It establishes a genuine single source of truth. You gain the hyper-tailored transaction analysis required to actually run the company without sacrificing the peace of mind of standard tax reporting.
Okay, but wearing the hat of a skeptical executive for a moment, initiating the development of custom software sounds like a colossal internal distraction. I don't have the bandwidth to be a software project manager.
That is a highly valid barrier to entry, but the reality of modern bespoke implementation is vastly different from internal development. It's a highly collaborative discovery process driven by an external developer.
So the executive team maps out the operational bottlenecks, and the development partner handles the entirety of the technical heavy lifting.
Exactly. It isn't a scenario where the company flips a switch on a Friday and everyone comes in on Monday completely unable to navigate a rigid, unfamiliar system.
Oh, thank goodness. So how does it actually roll out?
A successful bespoke rollout is executed in phased, user-centric stages. The fundamental philosophy is adapting the technology to how your people already work.
Rather than forcing your workforce to learn the quirks of a generic platform, they analyze the manual workarounds your team is using, like those dreaded CSV exports.
And they build background automation to eliminate them invisibly. And, the output generated by this custom logic completely transforms executive visibility.
Like the capability to deploy AASB-compliant custom dashboards, right? Let's define the value of that compliance for a second.
ASSB-compliant dashboards mean the system automatically aligns its outputs with the strict reporting standards of the Australian Accounting Standards Board.
So an executive can pull up a dashboard and instantly view real-time cash flow forecasts and profitability margins broken down by individual project or department.
Yes, knowing the underlying math is already compliant. There is no need to export data offline to manually reconcile whether a specific division is actually generating a profit.
The dashboard reflects the actual real-time reality of the enterprise, which brings us to the financial return on this custom architecture.
Right, going back to that paralyzing 0.07% national productivity flatline we mentioned earlier.
Yeah, how does dropping this bespoke V8 engine into a business actually generate measurable momentum against that macro trend?
The performance metrics are highly compelling. Enterprises that transition to a bespoke layered architecture routinely document efficiency gains between 30 and 45% within their finance and operations teams.
Wait, 30 to 45%. Recapturing that much of a department's total capacity is transformative.
It really is. It shifts the finance team from being historical data entry clerks to forward-looking strategic analysts.
And the mechanism driving that massive gain is the total elimination of manual exception handling, right?
Exactly. By automating the data translation between operational systems and the accounting layer, you remove the human double handling entirely.
Plus, by embedding custom logic to interpret specific award rates for STP Phase 2, you eliminate those forensic payroll reviews we talked about.
Yes, and when you remove human intervention from repetitive data routing, you subsequently see a 30 to 85% reduction in critical errors.
Wow. In an era of automated ATO audit flags, driving your error rate down by up to 85% is risk mitigation in its purest form.
Absolutely. But beyond the operational efficiency, there is a fundamental shift in how the business's capital is deployed. Remember the trap of subscription creep.
The endless 5 to 8% annual price hikes for generic add-ons. Yes. How do we overcome that trap?
It requires elevating your financial strategy from an operational expense mindset to a capital asset mindset.
Right, because when a business relies entirely on 15 different generic SaaS subscriptions, that expenditure is pure OpEx. It is a sunk cost every single month.
Exactly. You are endlessly renting digital capacity, and the landlord just raises the rent every year.
But when you engineer a bespoke software layer, you transition that spend into capital expenditure or CapEx. You are building proprietary intellectual property.
You replace a compounding, fragmented liability with a highly scalable, owned asset. A custom system scales perfectly in sync with your operational growth.
And it does that without triggering arbitrary tier upgrades or user licenses.
Right. Because of this architectural shift, transitioning from a perpetual renter to an owner of a specialized asset, the long-term ROI for bespoke adoption is tracking as high as 290%.
290%. And owning proprietary, highly efficient operational infrastructure actively increases the enterprise valuation multiple of the business itself.
It does. It is the definition of a strategic advantage. It really encapsulates the evolution required to thrive in 2026.
It's the movement away from reactive bookkeeping, where leadership spends energy trying to categorize what happened 30 days ago, toward proactive, profit-driving strategy.
When your dashboards are powered by custom logic that actually understands the context of your business, they can deliver predictive analytics.
Right, so they can flag an impending cash flow bottleneck or a subtle profitability anomaly on a specific project long before the variance hits the finalized P&L.
You gain the capability to steer the ship before the storm hits. You can maneuver to capture fleeting market opportunities and proactively mitigate supply chain risks.
All while your competitors are still manually formatting CSV spreadsheets just to get their generic software to talk to their CRM.
That speed to insight is the ultimate competitive moat. Possessing instantaneous, flawlessly accurate financial visibility allows you to decisively outpace tech-savvy rivals.
Which really crystallizes the core thesis we've extracted today. Settling for the limitations of off-the-shelf accounting software transcends mere administrative annoyance.
It has evolved into a direct, measurable risk to your operational efficiency, your regulatory compliance, and your enterprise growth trajectory.
The inherent force-fit philosophy of generic platforms actively penalizes scale. It fragments your intelligence into data silos and subjects you to hidden subscription creep.
And it leaves your business highly vulnerable to automated compliance audits.
So if the operational friction we have detailed today resonates with your current environment, it is time to engineer a superior architecture.
If your team is burdened by manual double handling or struggling to secure a definitive real-time picture of project profitability, there is a better way.
Which brings us to the targeted solution for our listeners. It is time to engage with C9, Australia's leading custom software, apps, integration, and database developer company.
C9 partners intimately with business owners and executive teams to design and deploy accounting solutions explicitly tailored to your precise operational parameters.
They execute the complex technical lifting, specializing in the exact Xero and MYOB bespoke integrations that power the layering strategy we discussed.
They construct the definitive single source of truth your enterprise requires to scale securely and profitably.
You do not need to demolish your existing foundation. You simply need to partner with experts to build a high-performance engine on top of it.
I highly encourage every leader listening to visit www.c9.com/au.
Yes, go there to initiate a no-obligation strategic conversation today about fortifying your financial systems for 2026 and beyond. That website again is www.u.c9.com/au.
Evaluating how your current technological infrastructure supports or restricts your long-term strategic objectives is the most vital step an executive can take today.
And as we conclude this deep dive, please ensure you hit the follow button on the C9 podcast and business page.
The economic and technical pressures defining 2026 are complex, and sharing this analysis with other business leaders in your network actively helps elevate the entire Australian business community.
Equipping leadership with the knowledge to reclaim their operational efficiency is how we collectively break through that 0.07% productivity flatline.
We've navigated a massive amount of technical and strategic territory today, from the hidden mechanics of STP Phase 2 to the V8 engine analogy.
But as you return to managing your enterprise, I want to leave you with one final, highly specific question to ponder. Next time your finance team informs you that the month-end close will take 5 days to finalize, ask yourself this.
Is your business data genuinely that uniquely complicated?
Or is your generic software simply forcing your team to translate it all by hand?